The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. Now, in the aftermath of the Federal Reserve's latest policy decision, the global economic landscape is entering a moment of reckoning. While the Fed holds rates steady and signals potential cuts ahead, deeper structural shifts are beginning to challenge long-held assumptions about U.S. economic dominance. At the center of this transformation, growing calls for de-dollarisation, changing capital flow patterns, and a surprising decoupling between the U.S. dollar and treasuries, two pillars of global financial stability. So how resilient is the U.S. economy in the face of these headwinds? Well, to find out more, joining me in the studio now is Gautam Chadda, who is the head of Strategic Advisory of Asia at RBC Wealth Management. Gautam, welcome back to the show.
Thanks for having me. Great to be here.
Thank you so much for joining us. Well, Gautam, the U.S. Fed has held rates once again. Was this highly expected? I mean, how do you interpret the Fed's decision to hold rates steady? What signals are they sending to the market right now?
Absolutely was expected, and I think it's the third or fourth consecutive month where we've had no change from the Fed in terms of the interest rate decision. But what did come out from the signals were the dot plots. And again, very little change from recent months, but when we compare the dot plots from March, there are now 2 rate cuts priced in for 2025. But interestingly, they're expecting, they being the Fed, inflation to be a little bit higher and growth to be a little bit lower, and that's really the signal that's coming out. In his testimony, Jerome Powell, the Fed chair, actually cited the tension between their dual mandates. So as a reminder, the Fed's responsible for price stability, i.e. inflation control, and full employment in the labor market. And they're seeing this as a tension between the two. And that's really where they're on a wait-and-see mode at the moment.
Right. I mean, as you mentioned, despite inflation still being above target, officials have continued to pencil in those 2 interest rate cuts this year. But, Gautam, is this still plausible? I mean, do you think the market is too optimistic in pricing in easing? I mean, when do you see those cuts coming in?
Actually, our RBC Cap Markets forecast is for 3 cuts this year and a further 3 next year. And their rationale is quite interesting. We're likely to see, and the Fed alluded to this in the press conference with Jerome Powell, that inflation from the impact of the tariffs hasn't really flagged up in consumer cost inflation. Right. And so is yet to come through. But we're likely to see a bit of an air pocket of steady inflation prints over the next few months. What we might start to see, though, is employment in the sectors related to trade starting to pick up. And if unemployment starting to pick up, and if that's the case, it might give the window for the Fed to think about cutting rates because inflation will be subdued at the high level with unemployment ticking higher.
Definitely. I mean, adding to your point there, I mean, you did mention that neither employment nor inflation data have yet shown a substantial impact from tariffs. But Fed Chair Jerome Powell, he says that the committee continues to expect tariffs to work their way into final prices, but that it would take time. So to what extent are new tariff threats or even geopolitical factors, in fact, influencing Fed policy indirectly?
Well, we're seeing in the inflation prints at the headline level being quite calm, but actually underneath, when we see things like core goods price inflation, that's been on the 6-month basis less and less deflationary to the point where it's become incrementally inflationary at the sub-inflation component level. And the Fed is also looking at that, but we haven't seen, as I said earlier, that coming through in terms of tariff impact to consumer inflation just yet. That's anticipated to materialize in the coming months. That's one unknown. Another unknown is some of the geopolitical tension, particularly in the Middle East right now, and the potential for that to provide some choke points to the transfer of energy assets out of the GCC to the rest of the world. And that could also be inflationary. Now, the question will be how long such a potential escalation persists and how long energy supplies are disrupted to whether that's a more permanent feature on inflation or not. And last of all, we've already started to see in some of the consumer surveys expectations for longer run inflation are just ticking much higher. So I think the Fed is really wait and see. They're waiting for some hard data to come through, but it's not, as you say, it's not a slam dunk yet for them to start cutting rates at this stage.
Okay. Well, in the Fed's updated economic forecast, officials raised their median estimate for inflation at the end of 2025 to 3% from 2.7%, and they marked down their forecast for economic growth in 2025 1.4% from 1.7%. I mean, for years, the U.S. economy has stood out for its resilience. So is that narrative starting to crack under current macro pressures?
I think we can take a step back and think about, well, is this the end of US exceptionalism? That's certainly what the financial press is talking about. And we certainly don't think that's the case. But we do think there are very valid points for investors to consider what we would term a diversified or multipolar investing. And so some of these factors would be, historically, the premium of GDP growth that the US enjoyed was a little bit higher than some of the other regions. That's narrowing much more so. We've had valuations in the US are far more expensive than they are in other parts of the world, such as Chinese equities or European equities. And so the valuation extreme differential is also something that investors for the long-term time horizon have to be cognizant of. We see portfolio reallocations beginning to happen this year. We see the dollar weakening, which is causing some of the currency moves, but also from a non-US investor perspective, having such a large portion of your assets into just one market that's rallied a lot in the last couple of years, it may be prudent to think about diversifying away into other regions just from a diversification perspective. And that's what we're seeing start to happen in the first 5 months of 2025.
You mentioned diversifying away and into other regions. What other regions in particular are investors interested in right now?
One of the areas it's done very, very well in a short space of time has been European equities. And no surprises, there's significant steps from the German government, for example, to release the debt brake and talk about hundreds of billions of dollars of infrastructure spending and defense spending. And so you've seen industries and companies linked to those future planned expansions of fiscal policy start to rally quite a lot. We're neutral weight European equities. We think maybe in the near term the rally has gone some way, and there's still the outstanding issue of the tariffs negotiation between the EU and the US. So, but I think we'll be looking for pullbacks to add long positions there. The sentiment around assets in Chinese equities, for example, has really materially changed compared to the last couple of years, where not just the valuation, but certainly the rally that you're seeing, that the policymakers' intent to help with lower interest rates and some fiscal policies and some helping of the consumer with various policies that they've enacted, that's also something positively received by markets.
Okay, so if more investors are moving out to other regions here, what are the biggest risks to U.S. economic leadership going forward then?
From our perspective, I don't think it has to be a binary outcome like sell US and go into other regions. We think much more a balanced portfolio of still have some US dollar exposure or US exposure to US assets. But for those investors who don't have anything else, it's really sensible to have other regions, whether it's the debt or the equity that you hold, as well as some alternatives. And we've spoken before on your show about gold as well, and we would continue to advocate those types of portfolio hedges for clients. I think the key is if you already have a diversified portfolio, which is what we would advocate, then you're probably in good state. And then it's just basically tilting the allocations between the regions based on where you feel the favored risk reward is.
Okay. Well, I mean, we're seeing countries like China, Russia, and in parts of the global south shifting away from the dollar-based trade. How real is the threat of de-dollarization to the US dollar's dominance?
Actually, I think the answer to both of those points is probably yes. The threat is very real in terms of de-dollarization, and we're seeing that with significant buying from central banks to the point where a recent ECB report cited that the second largest asset held by global reserve managers is gold after the US dollar. And I would say after the US dollar. So to your point about the dollar's dominance, it still makes up over 50% of central bank reserve assets because the depth of the market, the liquidity available in the assets, the sophistication of some of the derivative instruments for hedging and other needs. So it's going to take, I think, our view is that the US dollar as a reserve currency will be here for some time, but certainly at more than just a little bit more than just the margin, you are seeing a move away to diversify out of the US dollar. I think the question comes for investors is, what do I go into? And that's where it becomes really, really challenging because that's where the dollar is the behemoth in the room. But gold, as we've discussed before, has certain qualities which are helpful to those central banks in the current scenario. And to that point, we were increased our overweight to gold and actually silver a couple of weeks back just to double up on that bet.
Speaking of which then, can central banks meaningfully diversify away from the dollar, or is this more of a political signal than an economic reality?
When the central bank is looking to position, our view is that after the Russia-Ukraine conflict escalated further in 2022 and the Russian central bank assets were frozen, it really caught the attention, particularly of the global south central banks. Look, if I'm not favored by the US government, then I could be shut out of the US dollar system, freezing all my treasuries and other US dollar assets. So I need to start diversifying. What asset class can I hold that will have no counterparty or credit risk to any government, whether it's US or another. And that's where gold became an option. And we've started seeing a lot of those central banks buying gold in size. It's been reported at about 1,000 tons of gold a year from central bank purchases. And we think that trend of buying by the central banks is set to continue. And that's really the one go-to asset that the central banks have been doing. And the thing about the central banks is they're not traders necessarily. They're buy and hold on the whole because they're holding the reserve assets. The other thing that they're doing is they're also price insensitive buyers. They're not always out to make money. Their responsibility often is financial stability within the economy that they're helping to manage. And so it's a different profile of buyer.
Definitely. Well, if the dollar's share in global reserves continues to decline here, how might that reshape global financial markets and U.S. borrowing costs?
I think the U.S. borrowing costs will be much more related to where is the marginal buyer for U.S. debt and what's happening with the deficit and concerns around the size of the U.S. debt, the increasing nature of the U.S. debt and the debt serviceability of that. And there'll be much more drivers on the price of U.S. debt and the yields available on that. Whereas for replacing the dollar, our view is that it's unlikely to be fully replaced, but probably the alternatives are very, very low. Either the currency alternatives don't have the depth of markets, liquidity available, and so it's probably a spread of those that's likely to be at the forefront of reserve managers' minds at the moment.
I see. Well, traditionally, the dollar and treasuries have moved in tandem as safe haven assets. Are we seeing a growing divergence between the two now, and will this continue with rates being held again?
It's interesting. When we had the tariff tantrum or the tariff investors were terrified of what these tariffs were going to be delivering. We saw an unusual pattern. Typically in risk aversion scenarios in markets, the dollar will rally along with gold, treasuries, and risk assets like equities tend to fall back a little bit. What happened this time is that the dollar fell as well, unexpectedly, and we've been looking for some of the reasons behind that. One of the key reasons we think is that the dollar has become one of the highest yielding currencies in G10 FX. And so it's being part of the carry trade where investors borrow in a cheaper currency, such as the yen or the Swiss franc, and then they reinvest the borrowed money into the higher yielding currency, which is the US dollar. When volatility rises because of risk aversion, all the value at risk calculations mean that these highly levered trades have to be unwound, and the largest positions are typically the highest yielding currencies. So in those scenarios, we've seen actually some evidence of the US dollar being sold off to try and shut down risk because of the carry trade. And so that's potentially one of the reasons why we saw that relationship break down in the taper tantrum earlier in April. And actually, while the US dollar maintains that yield advantage over other currencies, there's potential for that relationship not to be along the historical norms.
Okay. Well, then is this decoupling temporary, or does it signal a more permanent shift in how investors perceive U.S. government debt?
It's interesting. The recent volatility we had in terms of the geopolitical risk, the dollar hasn't behaved in the same way that it did in April. Again, a lot will come down to the other factors of why are we experiencing market volatility. Is it the market concern about the level of U.S. debt? Is that causing the volatility? Is it a geopolitical conflict which may escalate but may be fleeting for a period of time? It really depends on the driver of that and whether the drivers will lead to persistent relationship continuing.
Okay. Well, if this shift continues, what might a post-dollar dominant world look like? What assets or currencies could rise to kind of fill the vacuum?
We particularly like gold and silver within the portfolios. We've discussed many times. We maintain our overweight and we see the upside for the yellow metal still there for the reasons we've discussed, which is diversification away from credit and counterparty risk, central bank buying, but also retail clients are getting in on the act, and you're seeing flows from ETFs demonstrate that. And then it's really a case of being diversified and making sure that portfolios that we're building are resilient. And the only way of building resilient portfolios is to have high quality companies who can manage free cash flows through the cycle, whether it's the debt or the equity. We're increasing portfolio quality and being diversified across centers because it's very difficult to pick sometimes which way it's going to go. So again, building the resilience within the portfolio is key. Speaking
of which, overall then, how should investors reposition portfolios in light of these long-term structural shifts?
I think on the fixed income side, our view is certainly we're underweight US Treasuries at the moment, but we are increasing exposure to other non-US sovereign debts to make sure we've got some sovereign debt diversification there. We're also, as I said, increasing credit quality across fixed income. And from an interest rate sensitivity perspective, a lot of the concerns around US debt are going to be reflected in the long end. So actually, we're just keeping investment duration shorter in the portfolio at present.
All right. Some great insights from you there. Thank you so much, Gautam, for joining me today.
Thanks for having me. Pleasure to be here.
Thank you. That was Gautam Chadda, who's the head of Strategic Advisory of Asia at RBC Wealth Management. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.